Okay, chapter 26. We're getting close. There's only a few more chapters. That's exciting. If nothing else, be excited about the fact that we're nearing the end of the semester, right? So chapter 26 is about how we analyze potential capital investments. Remember, capital typically means large purchases like equipment, machinery, buildings, all those sorts of things, okay? And so it can be pretty scary in real life to sort of like pull the trigger on a decision like that to buy a new building or something that's going to cost a ton of money. I know even in my small business, when it was a building I knew I could build and the total cost was only going to be like $30,000, even that felt a little scary to me, right? To make that jump. And so I would have to say, okay, if I build a $30,000 building and it has 20 rental units in it and I can rent each of those units for $40 a month, so that's $800 for the whole building a month. Is spending $30,000 worth it, right? That's the kind of decisions you have to make. And then you have to go, well, what if I can't keep it fully occupied? What if it was at 75% occupancy? Would it still be worth it? What if it was at 50% occupancy? Would it still be worth it, right? Those sorts of decisions. So that's what capital investment analysis is about. And so we'll just kind of jump into it. So there's really four methods that we use. There's other methods that people smarter than me have come up with, but four that we kind of teach in introductory accounting courses. And they're broken into two categories. There's methods that do not use present values. We'll talk a little bit about what present values are, and then methods that do use present values. And so the four methods we're going to learn about are the average rate of return method, the cash payback method, the net present value method, and the internal rate of return method. If you've taken financial management, you've learned about these once already. And so this will be review for you. Anyway, so I'll just jump into the first one, the average rate of return method. So remember, so this falls into this category of methods that do not use present values. Okay, that's the first two we're going to look at. So the average rate of return is honestly what it sounds like. Okay, what's its average rate of return? So the way we figure it out is how much annual income does a capital investment make us divided by how much did we invest in it? Okay, it's that simple. And then the average investment is just the initial cost plus the residual value, what we think the asset will be worth at the end of its useful life. Oh, that's all the way back to accounting one, right? Residual value divided by 2. Okay, so if I buy something for $100,000 and I think it'll be worth $10,000 when I sell it, I'm just going to take 100,000 plus 10,000 divided by 2, and that's going to be $55,000 average investment. Yeah. So let's look at an example. So we're evaluating the purchase of a new machine as follows. The cost of the machine, 500 grand, has a 0 residual value, but that just means we think we're going to totally use it up before we dispose of it. Okay. The expected total income from the machine is $200,000, and that should be, is that total income, or I think that must be total income. That's got to be per year. Come on, textbook publishers. Well, let's take a look at how they work it out. And the expected useful life is 4 years. So we would say the average investment is computed as followed: initial cost plus residual value divided by 2. Oh, so no, so that 200,000 is the total income over 4 years. Okay. And then our average annual income. So what they did is took that 200,000, divided it by the useful life of 4. That gave them an average annual income of 50,000, and divided the average and divided that by the average investment, and they came out with 20%. So that's our average rate of return. Okay. What that means really is that, well, is what it sounds like, right? What this asset is going to bring us is a 20% rate of return over its life. I'm sorry? That, well, per year over its life. So it's an average over its life. So the advantage of this is that it's super easy to compute. And it includes the entire amount of income earned. The disadvantage is that it doesn't really consider the timing of the cash flows. And what I mean by that is I know that, like, if I have $1,000 today, or I can get $1,000 5 years from now. They're not worth the same thing really, because if I got $1,000 today, now if I just blow it on something, I just go buy $1,000 worth of candy or something like that, then it really is kind of the same. But if I were to take that $1,000 and invest it and make 6% a year over the next 5 years, then that $1,000 is going to be worth something in the future. We call that the future value of it, which is some amount of money worked on by time and interest is going to be worth more in the future. Okay. And so $1,000 today will have a greater future value than $1,000 5 years from now. It'll be worth, about $1,200, something like that. I'll give you an example of this. My mother showed up at my house a couple weeks ago now. She said, "Hey, I was cleaning out my old safe deposit box and I found these savings bonds that I bought for you. And they were like dated 1989 to 1992. So that was like the window of time when I was in high school. And the way savings bonds work is if you buy $100 savings bond, they sell them to you at a discounted rate. So that what they do is they say, we'll learn about present values. They'll say, okay, what's the present value of $100, 10 years, 4%? And so whatever that comes out to, $38, they sell it to you for $38, and then you hold it for 10 years, and then it's mature and it's worth its face value, which means you earned 4% on your money. Well, these things kept earning 4% all these years since then, 30 years. And so my mom was just like, you can hear, they're in your name. I just bought them for you, like for your future. And it was like $400 worth of these savings bonds. I was like, that's cool. And I took them to like redeem them because they've stopped earning interest. So I might as well put them in something that'll earn interest. And it was like worth over $1,000, right? So that was cool. I was like, you can bring me $1,000 anytime you come to visit, Mom. Maybe you should. Maybe that's the cost of admission to visiting me, $1,000 each time. But anyway, so that's kind of this idea of future values and present values, okay? We can either say, I have a certain amount today, and given a certain amount of interest and a certain amount of time, what will it be worth in the future? That's the future value. Or we could say, I know of some amount in the future, like I'm going to get $1,000 in 5 years. What's the present value of that? How much money would I need today, given 5 years time and a certain amount of interest, to equal that $1,000 in the future? That would be called the present value of that, okay? And so that will come up when we look at these other methods. So the second one that doesn't use these present or future values is called cash payback. So I got a little ahead of myself talking about present and future values. So this one also doesn't consider the present values. It's called the cash payback method, and it's simply just taking the initial cost and divided it by the annual net cash inflow. And the annual net cash inflow means if there's certain costs of an investment over the time and certain amounts of inflow I'm getting, the net is the difference, is the amount it actually brings in, okay, after its costs. So here's our example. We're trying to buy a machine, $200,000. Again, same information, right? 50,000 cash revenue each year, expenses of $30,000, including depreciation, and then the depreciation is 20,000. So remember, depreciation does not impact our cash. So that's why they're giving us that information, okay? So to figure out our net cash flow per year, we would take the revenue minus the cash expenses, which would be the 30,000 total expenses minus the 20,000, means that we would get a cash inflow of 40,000 per year, okay? The estimated cash payback then would be the initial cost, 200,000, divided by the annual net cash inflow of 40,000. So 5 years. I use this a lot because it's super quick and super simple and gives me an idea, right? It'll take about 5 years to get my money back on this investment. And it's actually a really good thing when you are presenting to, say, the bosses to say, hey, so what we figured out is that given the cash flow of this, it's going to take 5 years for us to get our money back on that. We saw earlier when we calculated this one, it was 20%. So now you see there's a relationship to that, right? 20% is 1/5. So if we earn 20% per year for 5 years, we've earned 100%. So this has a average rate of return of 20%, and the payback is 5 years. So that's a pretty good payback to me. I don't like to do things much lower than that personally, because I feel like I can do better passively in the market over a 5-year period. Not necessarily the last 5-year period has been pretty rough, but on average. So sometimes we have this issue where, I mean, that was nice and clean because we expected the same amount of cash flow each year. But for this investment, it has uneven cash flows. Okay. In the first year, it's going to have a $60,000 net cash flow. Second year, 80,000, third, 105, 155, 100, then 90, and then it's all used up. Okay. So when we have a problem that asks us if we have an initial cost of $400,000, what's the payback method? But then it's uneven amounts. In essence, what we have to do is we just have to sort of, you can either plot it out. They did this on a graph, or what I do a lot of times is I just take the investment, 400,000, and then say after the first year, I still haven't paid back 340,000 of that investment. And then after the second year, I still haven't paid back 260,000 of that investment. And then after the third year, I still haven't paid back, what, 155 of that investment. And then I'm going to make 155 in the fourth year. So my payback on that is 4 years. Does that make sense? That's how long. Again, these are all projections. So there are estimates. We're not going to know for sure until we actually use the asset. But based on that, we think it's going to take us 4 years to get back the money that we invested in the asset. Here they just plotted it, right? First year, 600. So they just did like a cumulative net cash flow. Then 140, 245, and then finally 400 at year 4. So the advantage, it's another one that's relatively simple, easy. In accounting, you'll hear people say quick and dirty, which means it happens fast, but the results are estimates, right? They're not super strong. Again, the disadvantage is that it kind of ignores this idea of the time value of money, the fact that money in the future may not be worth as much to me as money today. Okay. All right, so those were the two methods, the average rate of return and the cash payback method that don't use present values. So then the ones that do use present values are the net present value method and the internal rate of return method. And then at the bottom, you'll see it says there's a present value of an amount and there's a present value of an annuity. So again, let me go through again what present value is. So here's the idea. Assume you have $1 to invest as follows. The amount to be invested is $1. The period to be invested is 3 years, and the interest rate is 12%. We would say that the present value of this investment is $1, and then we could calculate what some future value at the end of 3 years would be if it earned 12% per year. Okay. So after 1 year, the dollars earns interest, and now it's $1.12. After the second year, the $1.12 earns interest. So you get more than 12 cents in the second year, right? Because of compounding. So it's 13.4 cents. And it'll grow to $1.25.4. By the end of the third year, we'll have $1.40 or 1.404. So this is called compounding. You've all learned about it. It's not new. It's not a new concept. So the idea with present value and future value is that this sort of calculation could go either way. We could say, I have $1, and at 3 years and 12%, its future value at the end of that third year will be $1.40.4. Okay. You gotta have that 4/10 of a cent. Don't forget that. We could also say, what's the present value of 1.404 at 3 years, 12%? The answer would be, it's $1. In other words, the present value means how much would I have to invest today to have a given amount in the future, knowing the variables of time and interest. Okay, that's all it means. So it can go in both directions, and that's a little confusing, but it's actually something that gets used a lot in business, present value. It's the same thing like my son and my daughter, my son-in-law and my daughter, they just sold their house to someone and they carried the note on it. Okay, they sold it on Zillow or whatever that website is. Is that where you sell real estate? Okay. And they carried the note. And so they sold it for $115,000. And then the person's making payments to them. Well, as soon as they logged that with the county offices, somebody who does this for a living, they're called factors, okay? That's the name of their job, as a factor. They contacted them and said, hey, I see you've got a note for $115,000, 10 years at 4% or whatever it was. I'll buy that note from you. So this is what people who factor do. So what they do is they calculate out the present value of this future series of cash flows, right? What is 10 years worth of payments of a certain amount at a certain interest worth in today's dollars? And then they'll offer some discount to that. So, they might say like, this whole thing will pay out $130,000 over its life, the principal plus the interest. I'll offer you $94,000 today. You can take your cash and walk away. And what they're using is present value concepts. Okay. My son-in-law had never heard of that. He was like, what the heck is this? Is this real? Is this legitimate? I was like, yeah, people do it all the time. But I'd never heard of it until I was probably in my 30s. It's kind of a specialized side of finance. All right. So this is called a present value table. And what it does is it gives you a factor. Okay. So it says the present value of $1 at compound interest. So if I were to say to you, what's the present value of $1 3 years, in 3 years at 12%? What we would do is we would look at this table and we go down to year 3 and we go to 12% and we bring our fingers together and that would give us a factor. Okay. And then we could calculate the present value of $1 by multiplying that factor by $1. So the present value of $1, 3 years, 12% is 71.2 cents. That means if I had 71.2 cents today and I invested it at 12% for 3 years, it'd be worth $1 at the end of 3 years. Does that make sense? How that all works? Because it will confuse you when you get into a problem. The reason they do these tables at $1 is because we can then use that factor. So if I say, what's the present value of $257,000, 3 years, 12%, I can go 0.712, multiply that by whatever the number I just said, $257,000, and that will tell me the present value of $257,000. Okay, just so you know, there's also an Excel function that will calculate present values for you. The table is just kind of the old-fashioned way. If you think about it, if you can have a factor table, then Excel should be able to do that too, right? And so it's just equals PV, present value. You can play with that if you want to. All right. In real life, though, it's not always a single lump sum. It's not always the present value of some amount in the future. It might be, what's the present value of an annuity? And an annuity is a series of equal net cash flows at fixed intervals. So like my son-in-law and my daughter's case, if they're collecting whatever it is, $900 a month in payments from the people they sold the house to, okay, then that factor who has to figure out how much they would offer to buy that note for, they have to say, this thing is paying $900 a month times 12 months times 10 years. Okay. And that's, so whatever that is, it's a series of $900 payments for 10 years. And so the present value of an annuity just asks that question. If I was going to get 10 years worth of $900 payments, how much would that be worth in today's dollars? Does that make sense? That's what the present value of that is. So present value of $100 annuity for 5 periods at 12% could be determined by using the present value factors and the partial present value of $1 table, but that's some crazy stuff. Or we can use a present value of an annuity table. So you could do this, right? You could say, okay, so in the first year it's that much, in the second year it's that much, and we could add it all up and that would tell us. Or there's a separate table that's called the present value of an annuity of $1. And again, you'd say that one was 5 years, so 12% 5 years. There's my factor. You will see that with present value of an annuity, the factor is always greater than 1. Why? Because it has the addition of principal being added every year, so it's going to be more than just the 1 year amount. Whereas with the present value of a dollar table, it's going to be less than 1 because we're never adding, well, not always less, but most of those factors are less than 1. Okay, so then we just take $100 times 360.5, and we'll see that it's worth $360.50. They also use this with like lottery winners, right? When they say, do you want to take 20-year payment of this amount? Or do you want to just take a lump sum of 50% of what the jackpot was or whatever, right? They use the same sort of math. For retirement systems, like my teacher retirement, what they've put, I'm putting this money in there, and when I retire, it'll be worth $800,000. And I could either just take out the 800,000, or I could say, I want an annuity. I want you to pay me a stream of income for the rest of my life. And so that's what annuities are. Okay. Anyway, so now that you have an idea of the concept of present value, which I know again was review for some of you, we're ready for this first method. Remember, to bring us back to what we were talking about, it was methods for evaluating capital purchases and things like that. Okay. And that two of them, the first two we looked at, didn't use present value, but these next two will. Okay. So this first of the ones that do use present value is called net present value. And it kind of brings together all of these concepts. So again, we have this example: cost of the new equipment, expected useful life, minimum desired rate of return. This is new. Okay. This is, sometimes they'll call it your target rate of return. This is how much the business has decided they want to earn on an investment, because if usually that gets set based on what their ROI is on other things, right? So if our ROI is 10%, we don't want a new investment that earns less than that. Okay, but this will be given to you in a problem. And then the expected cash flows to be received each year. So what we do is, to find the net present value, is we find the present value. So for year one, it's the present value at 1 year. 10% gives us the factor. So the present value of the first year's cash flows of 70,000 is 63,630. In other words, if we had 63,630 and we could earn 10% on it, it would turn into 70,000 by the end of the year. But then for the second year, now we do 2 years at 10% to find this factor. And then 3 years at 10% to find that factor, and then 4 years, and then 5 years at 10%. And at the end, we get the present value of all those cash flows, and we add them up. And then we subtract the amount of the initial investment. And that gives us what's called our net present value. So here's what a net present value means. If net present value was 0, it wouldn't mean that we didn't make any money on this investment. It would mean we made exactly what our target rate of return was. Okay, so 10% per year. So anything positive means we're doing better than our target rate of return. Anything negative means we're doing worse than our target rate of return. So because we factored in that target rate of return into our present value factor, then getting a net present value of 0 means our cash flow, our discounted present value cash flows, equaled the amount of our initial investment. Okay, so why is this factor decreasing? Because the present value of some future amount, the further out it gets, the lower the present value is. So if I was going to try to get, if I need to get $40,000 at the end of 5 years, then I would have to invest $24,840 today. But if I was going to try to get 40,000 at the end of 4 years, I would need to invest 27,000. I'd have to invest a little bit more. So my present, does that make sense? So that's why the present value declines over time, because it's giving more time for us to earn that amount. I'll tell you, when I first learned about present values, it broke my brain a little. It took me a while to like see how they all interrelate. And so in the beginning, sometimes you just have to work with it. And then in time, it kind of comes to you. Oh. So the net present value, like I said, indicates the purchase of the new equipment is expected to recover the investment and provide more than the minimum rate of 10%. So typically we set this hurdle rate or this desired rate of return, and we just know if anything's above, if anything's got a positive net present value, that makes it a desirable investment for us because it meets our minimum requirement. If it's got a negative net present value, it doesn't. So the advantages, of course, is now it considers this idea of the time value of money. It considers all the cash flows. It helps us to rank projects with equal lives to see which is a better deal. Disadvantages, it's more complex, right? Again, there's an Excel function equals NPV. The downside, and I haven't tried it yet with the Cengage homework, is when you use the Excel function, like you think about it, if you're using that table, it only gives you the factor to like 3 decimal places. When you use Excel, it's going to give you the factor to like an infinite number of places. It just, or almost like you don't even see it. It just, you'll see whatever you have it rounded to, but it's going to continue calculating based on it. And so you'll have slightly different answers. And I don't know, we'll see how Cengage plays with that. Okay. The only way I've ever found to make those, when you have those rounding issues in Excel, to make it work, because if you try to just round it on Excel, it still uses the full number in its calculation. So you almost have to like retype it. So if it's like 1.327 blah, 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 if you just retype 1.32 after you've done the factor, then it will only use that. But that's kind of a hassle. All right, the present value index is just the total present value of a net cash flow divided by the amount to be invested. Okay, so we just figured out how to calculate the total present value. So for example, this one was the total present value was 202,900. So to find the present value index, we just take 202,900 divided by 200,000, and it gives us 1.0145. Again, we use that a lot when we're comparing multiple investments. You can just see really quick. That way it's not based on, because what if one investment is like a $400,000 investment that's going to return 404,000 in present value? When they're unequal like that, it's hard to tell. But by turning them into an index, you can quickly see which one's actually bringing a better return relative to its cost. So here's their examples. Total present value of the net cash flow, 107,000 on proposal A with 100,000 to be invested, 86.4 with 80,000 on proposal B, 86.4 with 90,000 on proposal B, or C, I mean. We can calculate the net present value, and then we can calculate the present value index, and real quick see proposal B is actually the best deal. Okay, that's how we use it. Let's see. Project will have a present value index of greater than 1 when the net present value is positive and less than 1 when it's negative. All right, the fourth and final type of way we analyze capital purchase decisions is called the internal rate of return method. This is another one that uses present value concepts. So again, Excel has a function equals IRR for internal rate of return, and I'll show you some of these when we do the guided problem. But so it says, assume the management is evaluating the following proposal to purchase new equipment. There's the cost, the yearly expected cash flows, the expected life, and the minimum desired rate of return. So we take the annual cash flow times the present value factor, gives us a present value of the annual cash flows, minus the amount to be invested, gives us the net present value. So we can see at a glance here that this thing is making more than the target or required rate of return because it's got a positive net present value. The question is, well, how much more, right? Is it, 12% is our target, but it doesn't know. I mean, we don't know just looking at it. So we can use trial and error if we want and figure out, in essence, just do the math of it, that it's roughly around 15%. Or instead of using present value, we can go through this process to calculate the internal rate of return. I mean, instead of using trial and error, we can use this process. So the present value factor of an annuity, the amount to be invested by the equal annual net cash flows. Then we locate our present value factor in the present value of an annuity table. Then we identify the internal rate of return by the heading of the column in which the present value factor in step 2 is located. So here's an example. Cost of the equipment, $97,360. We expect $20,000 a year in cash flows to be received. It has a 7-year expected useful life. So in essence, what we do is we go to the table, present value of an annuity. We look at 7 years. We find this factor that we calculated by taking the cost divided by the cash flow. That gives us this factor of 4.868. And then all we do is we go down to 7 years and we go across until we find the factor that we calculated. And then we go up and be like, oh, so its rate of return there is 10%. Okay. That's all. It's pretty easy. It's even easier when you use Excel function equals IRR, internal rate of return. And again, I'll show you how to do that with the guided. So what's the big advantage of this to me, let's see, is that it does consider the time value of money, but it's this one. It ranks proposals based upon their cash flows over the complete useful life, even if the project lives are not the same. That's a limitation of net present value. It's just hard to compare things in the same way. The downside is it's complex. I mean, even if you're looking at the table, you have to like figure it all out. It just takes more time and more effort, but computers kind of render that argument silly because once you have it set up as a tool, you just put in your cash flows, your initial outlay, and you can just calculate it. It's pretty easy. So that's it for this chapter. That's kind of the new stuff. I think time value of money is, again, one of those things that like it gets explained to you and you're like, okay, I got this. And then you go to work with it and you're like, wait, how did that all work? And it just takes a little bit of practice to get used to. All right. All right. So have a great day. And thanks for the 6 of you who actually came. That's nice of you. Makes me feel like maybe somebody thinks I have value to give.